Hello, welcome to the Nienow and Tierney podcast. We're excited to be with you today and have some fun things to discuss, I think, anyways.
Yeah, not talking on our normal Friday afternoon. It's a Wednesday, but I think. Oops, hold on a second. But after getting through tax, we'll leave that in there. What the heck? But after getting through our tax season last week, it was good to kind of take things easy on Friday and reconnect today on Wednesday the 21st.
Yep, absolutely. So it feels good to get through that 15th deadline for sure. It's always a relief. And we couldn't do it this Friday because, frankly, I'm going out of town. So it's nice to do that today.
Yeah. So we're officially through the 2019 tax filing, the tax season that never ended, the most bizarre year.
Mm-hmm.
Um, I felt, I don't know, in some respects, it felt like it went well. I mean, I think our clients, I don't know, maybe taxes just weren't on their mind back in March and April and May when things got pushed back to July. So they kind of went with the flow. I don't know. It's interesting to be in this position and look back.
Yeah. Yeah, it was pretty smooth for the most part. I didn't care for that I was working, I think, on July 3rd
Yeah.
on the holiday, so I didn't appreciate that as much. And I've always said um, I don't mind tax season because it comes in the worst weather of the year for us, which is clearly like the worst weather for us is like nothing compared to other people.
Right.
But
Right.
if I have to work hard during the summer or overtime in the summer, I would quit practically.
Yeah.
But yeah, it was good. It was smooth, not too bad.
I felt like it's it smoothed out the compression of work that we normally have in March and April. I think I know I and you and our staff didn't take vacation, so we had more time available to do work, and yet at the same time, all of that I think available time that was added was taken up by figuring out working remotely. And we spent hours and hours and hours trying to figure out all the new tax laws and the PPP loans and all that stuff to try and help our clients. So it was interesting for sure. But now that we're through the
Mhm.
2019 season, we can look forward to 2020 tax filing in 2020.
Yeah, yeah, exactly. Yes, Paul, I've been living 2020,
Yeah,
and
exactly.
so yeah, absolutely great to get through that. The filing, tax deferrals, payroll tax deferrals, PPP loan forgiveness. We're still a little bit involved in that, but so now I think we at least talked offline that talking about year-end planning, and as we head towards the end of the year and look as clients are kind of looking to us on what can I do to minimize my taxable income. Is there any ideas that you have? I thought it would be great for us to kind of explore, just have a discussion on what are some of the top 5 things that you think I could do before the end of the year to try to either minimize my taxes or at least be strategic in my taxes. So um, the first one that I had on my list was retirement planning. And so for those business owners that have a qualified retirement plan, now is a great time to fund those. If you don't have a plan, I think you're still not too late. You can set up a SEP IRA plan, but that is one of the best ways to be able to stick money away for retirement and get a tax deduction for your business.
Yeah, I agree. And not only just for your business, but employees. So, we certainly have clients that are wage earners, that are high income wage earners, and that is definitely number one strategy. Is if you're not maximizing uh, putting away money into a qualified plan, that's the first place to go. It seems, depending on particular circumstances. But
Yeah.
that's the first place to look.
Yeah.
And especially if you're an employee and your employer also offers a match.
Yeah.
So I mean, if your employer matches that and you're getting a tax savings, the return on your investment by investing into a retirement plan is huge.
I like what you said about employees. And I think from a business owner standpoint, this is a great tool that you can use to try to retain your employees, is to offer them a match. And then you can also dictate how they will receive that match. So there's different vesting opportunities there. So if you've got someone you want to hold on to, you can either put what's called a 3-year cliff on that vesting of that match, where they basically have to stay for 3 years in order to receive the match if they were to leave. Or you can do like a tiered where they vest, I think it's 20% every year for a total of 5 years. Kind of a good way to keep your employees with you and knowing that, hey, if I got to stick it out, because there's this nice little sum of money that I would receive upon retirement.
Yeah. And I think it's probably worth noting the 20,000 foot view of the two types of retirement plans that you can take a tax deduction for. So defined contribution plans and defined benefit plans. So the way the terms come around is there's a formula, basically the amount you put in times the return on investment equals what your benefit is eventually when you retire. And the IRS allows two different types of plans. One where you define the amount that you're going to contribute. So the amount you get when you retire is ultimately dependent on that formula. Or you define what the benefit's going to be eventually. And then that determines how much you have to put in now to reach that benefit eventually. So with a defined contribution plan, the amount that you can deduct is a limited amount based on the Internal Revenue Code. I don't know that limit. Do you know that off the top of your head?
I mean, I think the total, like for a 401k plan, is like $60,000 total between match and employee deferral. I think the employee deferral amount is, well, it's 18,000 or $19,000. And then if you're over 50, then you can get up to like 26,000 roughly. And those are, those defined contribution plans, those are typically your 401k plans.
Right. So there's a finite amount you can put in with a defined contribution plan. With the defined benefit plan, depending on your factors, how long it's going to take until you retire, the amount of your retirement benefit. So let's say that retirement benefit is, 80% of your last salary until the day you die. You might be able to make a tax deductible contribution into a defined benefit plan of, a couple $100,000 and even up from there.
Yeah.
The downside of a defined benefit plan is you're required by law to cover every employee, and it's a commitment. You have to be able to make that, $200,000-$300,000 contribution every year. It's not something you can decide this year, and then if business drops off in the future, you won't be able to do it. So it really only fits for somebody who maybe is they're the only employee of the business, and they have this consistent profit, to be able to contribute from each year. That's a really strong tax planning opportunity.
I mean, I have a client and they do a profit sharing contribution, and it's a manufacturing company. And I think that they put in on the profit sharing, I'm just going to use numbers, but it's like $125,000 into that. And I think like 100,000 of it goes to the business owners. And so you are providing a huge dollar amount into the business owners, but yet some for the employees as well, an incentive for the employees. But I mean, the way that, and I don't understand exactly how they carve this up and how you can determine what is allocated to each person. And there's, administrators that can do that, but it's a huge sum of money that they can put into their own retirement plans.
Yeah. I think we could talk about this forever, but my last thought on what you just said is, in my experience, so this is generalization for sure, but in my experience, the amount that you have to put into cover employees' benefits is usually offset by the tax savings you will get for the contribution. So increasing that profit sharing contribution, you're essentially being given a tax savings that you can then use to fund the amount that you're required to put in to cover your employees.
Okay.
Which is a win-win situation. It may not directly benefit the owner, but like you said, through employee retention and things like that, it's a great benefit to have that covered by the tax savings.
Yeah. The second one I had on here was kind of charitable planning, giving money to charity. Obviously, as a tax deduction, it's going to lower your taxable income. And especially in 2020, I think that there's a lot of planning that can be done with this because of the fact that you can actually contribute up to 100% of your adjusted gross income and offset all of your taxable income in 2020. Usually, you can only contribute up to 50 or 60% of your adjusted gross income. In 2020, you can actually make a charitable contribution up to 100% of your taxable income and you would pay zero tax. So I mean, obviously you have to have the cash to be able to make those charitable contributions, but if you are, this is a great opportunity and plan for 2020. Now, I will say it's got to be a cash contribution and it can't be to a donor advised fund. It's got to be a cash contribution in order to use that 100%.
Yeah. And then if the taxpayer is not going to do that, it doesn't have a situation where they need to contribute up to the 100%. Other tools related to charitable contributions that are good planning devices are, like you said, donor advised funds where you can put money, you can put tax deductible money into a fund that you then administer or you assist in administering over time to get that money to charities. And then I think taxpayers and clients that have a transaction, they're selling a property, they're selling a business or something like that, there's opportunities in those circumstances to use charitable remainder trusts and things like that to plan and help charities through tax savings. So yeah, good tools for sure.
I think maybe we don't want to go down this road, but like with the qualified business income deduction, if you're at some limits, using charitable deductions to get yourself below certain taxable income limits, it increases your potential business tax deduction as well.
Yeah.
Next thing I had was, purchasing new equipment. This is often what we see for business owners is, they'll buy, a new tractor or whatever they may need for their business. With the bonus depreciation limits and the Section 179, that's a direct write-off. You don't have to necessarily depreciate that over 5 years. Currently, you get an immediate deduction for it.
Yep. I think the one thing to note is that tends to be the case for federal, but not California. California doesn't give generous immediate expensing of equipment purchases, but it's still a worthwhile thing to do. If you need equipment and you're going to buy it in the next year, consider accelerating that into the current year.
I think the other caution I would say is it needs to be placed in service by the end of the year. So just, placing an order for it doesn't necessarily create the deduction for it. I think one of the other ones I had was we often will do some salary or bonus strategies at the end of the year. This specifically, I think, relates to either C corporations or S corporations that potentially need to create salary in order to maximize that qualified business income deduction. There's a definite sweet spot for that. So if you're not aware, there's a qualified business income deduction on flow through entities where they get a deduction for 20% of whatever flows through. But if their income is over $415,000 for married filing jointly, that can be limited if your either your W-2 wages are too low or you don't have unadjusted business income assets.
Yeah, you delved into the details there,
Mhm.
but you're right. The bottom line is planning through year-end bonus or salary is smart. I think the only other thing I would add to that is with S corporations, especially, you need to keep in mind that every employee needs to be paid what the IRS determines is reasonable compensation. So you can't underpay yourself, you can't overpay yourself. Uh, but the interpretation of what that is a mystery.
Facts and circumstances.
Yeah.
Yeah. And then the last thing I wanted to mention is, doing some year-end planning, doing some year-end bookkeeping. Now is the time to get your accounting records up to date. And we would love to be able to meet with you. We can project, what we think your taxable income is going to be. And so that you can make these decisions now based upon good information, and we can project for you, what do you need to pay now, maybe in estimates, maybe you're underpaid, overpaid, what are you going to need to pay at April 15th, and then what are your quarterly estimates going to be in 2021. So you can really have a good roadmap for your cash flow for like the next 12 to 14 months.
Yep, I agree. Year-end planning, smart thing to do.
That's all I had. Did you have any other planning ideas, suggestions?
I don't.
All right.
I think those are good. By the way, I like your tie.
I know. I had to remember how to do it.
No,
Sure.
I know. It has been a long time since I've put on a tie.
Yeah. We're just lucky we live in laid back California, I guess.
Yeah.
All right.
All righty. Good talking to you.
All right. Bye.